Welcome back. Now, the Naira weakened against the dollar for a second day on Tuesday after the central bank removed its currency peg in an effort to alleviate chronic foreign currency shortages choking growth. The Naira traded 1.1% weaker at 285 to the dollar, with $9 million traded. On Monday, the central bank sold $3.5 billion on the forward market after it auctioned $532 million and intervened on the interbank market to clear backlog of hard currency orders worth around $5 billion.
Monday's rate was sharply weaker than the 197 peg the central bank had been maintaining for the past 16 months, then abandoned last week in a bid to alleviate chronic forex shortages. Black market currency dealers were quoting the Naira in a spread between 325 to 345 Naira to the dollar, up to 10% stronger than on Friday, on expectations that more forex liquidity on the interbank market would reduce demand on the street. The central bank has said it may inject foreign exchange into the bank market to boost liquidity.
We are going to have different sources of inflow or supply to the market. Autonomous sources, the oil companies, the banks themselves, the CBN being the big player, all other sources of currencies that, within the this new interbank framework that have been listed as qualified to play within the market. We're going to see a lot of them playing.
With the likely sharp fall of the Naira, Nigerian products will become relatively cheap and imports more expensive, which should stimulate the domestic economy, but will likely light a fire under already rising inflation.
This is expected to normalize as exchange rates also correct, so the business can get back his groove. Even from the angle of fiscal policy, state governments are going to have more money, because of the dollar proceeds that had been exchanged at 197 or 200, before.
Nigeria's economy, which contracted by 0.3% in the first quarter, faces its worst crisis in decades after the decline in oil prices since 2014.
We're still talking about Nigeria's forex market. Analysts at Exotics Partners London believe that the currency flexibility at last reopens the investment debate. Now, according to their report tagged FX Towel Thrown In, investment case reopened. The analysts see this change in FX policy as a positive catalyst overall and says while the country's investment case remains challenged, it is no longer untouchable. Well, I'm now being joined by the head West Africa Research Exotics Partners London, Esili Ebe. Good afternoon. Thank you for joining us, Esili.
Good afternoon, Chenzia.
Now, immediately after the announcement of the flexible FX market, of course, we saw the stock market rally. Does that mean that we will begin to see more investment into the country now?
I think it's fair to say that, like you pointed out on our note, it kind of reopens that debate, is Nigeria investable, is it not? Prior to, the FX market liberation last week, it was simply not touchable. It wasn't a discussion that would come up between, conversation between myself and a client, for example. They were obviously a lot more interested in other markets. Nigeria was no-go.
So now what would you say, having been researching on this, having been following the market, what would you say is Nigeria investable?
Well, I think that, the FX policy definitely opens up that debate. I think that there's still a lot more that needs to happen. Don't forget that there's still so many issues, challenges that need to be obviously dealt with. One, you have declining economic growth. First quarter numbers were down. We can obviously say this year that, it's probably going to slow. The World Bank currently has about 0.8% GDP growth. You have a fiscal deficit. You have some sort of security issue or crisis in the Niger Delta. And who knows where oil prices will eventually settle. I think that there's still downside risk to oil prices, which obviously implies that, the overall economic environment itself is still very fragile. And so in that context, I'll say that a currency deval or movement to a liberalized market is not enough. But again, I'll continue to use that same phrase. It's enough to get that debate going.
Right. It's not enough. So what can we do to actually boost this effort? What do you think the federal government should be looking at to boost the monetary effort of the central bank?
Yeah, I think obviously from a fiscal side, there probably needs to be some sort of a stimulus. But as you know quite well, that itself has been limited by obviously the ability of the federal government to also, increase revenue. Obviously, a lot of effort has gone into sort of boosting non-oil revenues, but I believe that would take obviously time, obviously over the medium term, for probably even 5 years before you see any. But we need to get things done right now, and so with the Niger Delta crisis, clearly it's probably difficult for you to even see that improvement in oil revenues because oil output has fallen despite having relatively high oil prices. So I think that's one challenge that may likely remain over the short term, in that you have a federal government that would like to stimulate the economy, as you've seen in the budget, but don't obviously have the resources to do that. So it seems to me like, the CBN again will continue to be the champion of sort of trying to create the enabling environment, I guess, to drive macroeconomic growth and also attract foreign investment.
All right. In your report, you talked about the banking sectors, net positive change. Now, what kind of impact are you looking at this having on the banking sector, especially in the area of financing or refinancing businesses?
Well, for one, it sort of reduces the risk around sort of currency movements, because if, for example, you were a creditor to a bank, you were obviously a borrower to a bank, and you take in a certain amount of dollars, and you've obviously found it difficult paying, as we currently have a number of oil companies, fraught with. I think that it basically allows a lot more flexibility with the banks refinancing that debt, given that there's somewhat clarity on, I guess, a possible direction of the currency. Now you're also talking about FX forwards as well. So even the banks can go into positions where they sort of hedge their currency risk if they wanted to. And so it's in that context we're saying that the ability to refinance some of those oil and gas debt or other dollar-denominated debt is obviously a lot easier. But I think that from a bank perspective, it goes even more than that. Clearly, we can expect an increase in their non-interest income this year because obviously being able to trade FX allows you to significantly boost obviously earnings or income from trading FX particularly. But I believe that there'll be also other avenues as well for them to increase their non-interest income.
All right, Isili, let's just take a quick look at what the interbank market is trading now. Thank you very much for your time. Now, the interbank foreign exchange market opened today at between 283 to 284 Naira to the dollar, and it's just a few minutes to the close of the market. Let's bring in Forex dealer at Access Bank, Kinsley Azom, to tell us how the market has performed today. Good afternoon, Kinsley.
Good afternoon.
Now, how would you compare the opening figure of the market to what we have right now?
Well, typically nothing has changed. Like you said, it did open at 283, 284 levels. Got to a high of about 286 on the upper side. But right now it's still trading at opening levels, which is at 283, 284.
Okay, so what are your observations in terms of the sentiment of the market today?
Okay, well, considering that the CBN had cleared the backlog, so there seems to be less pressure in the market. We've seen the sell side trying to fill in the market to see, okay, if it's the right time for them to come in. And I'm talking about the IUCs and other customers who have significant inflow. So there's a bit of calm in the market since that backlog has left us. So there's less pressure in the market now.
All right, thank you very much for your time, Kinsley.
You're welcome.
Right, well, we'll take a quick break, and when we return, we'll look at the fixed income market for today. Do stay with us.